Take a look at this chart. If you look up compound interest, you're almost always shown the sweeping, dramatic curve on the top, the one that arcs up into millions of dollars over a few decades. But if you're consistently investing $50 a month, your actual account looks like the bottom trajectory, a nearly flat line that barely seems to move for the first 10 years. Check your balance after a few years of rigid discipline, and you might think, is this it? That disappointment actually has a name. It's called the Phase 1 feeling. Your money is technically compounding, but the return is so small that your account balance is effectively indistinguishable from a basic savings account. Behavioral economist and Nobel laureate Richard Thaler described this dynamic as the feedback gap. In human psychology, we continue behaviors when they produce visible results, and we abandon them when they don't. Early investing generates returns that fall well below the perceptual threshold your brain registers as meaningful progress. Your brain looks at the math and concludes the strategy is broken. The accurate reading is that the system is working exactly as designed, just at a scale too small to feel yet. But that gap between mathematical reality and your lived experience convinces perfectly rational people to abandon entirely viable wealth-building strategies simply because they lack short-term validation. When you hit that feedback gap and see underwhelming numbers, you know something needs to change. But almost everyone makes the exact same false diagnosis. You conclude your return rate is too low. The natural reaction to that diagnosis is a strategy switch. You stop buying boring, reliable index funds returning 8%, and you start chasing a 16% return by moving into individual stocks, speculative tech companies, or complex trading strategies. We have precise data on how that strategy plays out. Researchers at UC Berkeley tracked 66,000 individual brokerage accounts over a 6-year period. The most active individual traders earned an annual return of 11.4% during a window when the broader market returned 17.9%. That is a massive 6.5% annual underperformance. That underperformance happens because pursuing double-digit returns demands a level of volatility most humans cannot handle. In real life, an attempt to achieve a 16% yield usually ends in panic selling at market lows and buying into recent winners after they've already peaked. Obsessing over your return rate does not solve the problem of a slow-growing portfolio. Instead, it introduces catastrophic behavioral risk into an otherwise sound mathematical equation. The real issue is much simpler. Almost every piece of financial advice treats wealth building as a single continuous process. It's not. There are two completely distinct phases of investing, and they are governed by different mathematical rules. Think of compound interest like a turbocharger on a car engine. A turbo uses the engine's exhaust gases, the waste energy, to spin a turbine that forces compressed air back into the cylinders, creating a powerful feedback loop. But turbos don't work at low RPMs. Below a certain engine speed, there isn't enough exhaust pressure to spin the turbine. The turbo is physically bolted to the engine, but it isn't doing anything. Apply that exact mechanic to a $10,000 investment portfolio. An 8% annual return generates roughly $800 a year. That's $67 a month. $67 does not change your life. It barely covers a tank of gas. In Phase 1, your return percentage is irrelevant noise. The turbo is technically running, but it has no pressure. Every bit of forward momentum comes entirely from the manual combustion of your physical monthly deposits.
You are the engine. This bar chart proves it with a 10-year stress test. On the left, we have a $200 monthly contribution achieving a near impossible 16% consistent return, yielding about $52,000. On the right, we increase the contribution to $350, but leave the return at a boring 8%. The right bar reaches $64,000. More money, completely devoid of behavioral risk. But the right bar also gets you somewhere else much faster. Right around the $100,000 to $150,000 mark in invested assets, the entire mathematical dynamic flips. This line is the phase transition. Phase 2 is the exact moment the turbocharger engages. Drivers call this being in boost. Suddenly, the power delivery changes completely, and your compounding returns begin generating significantly more monthly wealth than your manual deposits ever could. Before the turbo kicks in, your contributions are the strategy, and compounding is the reward you collect later. Your absolute, undeniable priority is to force your pile of money across that $100,000 threshold as fast as mathematically possible, by any means necessary. This timeline visualization reveals exactly how time dictates value. $1 invested in month 1 of a 30-year portfolio at 8% becomes $10.60. That exact same dollar invested in year 25 only compounds for 5 years and becomes $1.47. Your earliest dollars have 7 times the compounding power of your later dollars. To capture that power, you need to pull structural levers. The first is contribution right-sizing. Most people invest less than they should because of institutional inertia. They set an automatic transfer years ago and never updated it as their income grew. Logging in right now and increasing your automated deposit by just $50 takes 15 minutes and completely overrides that inertia. The second lever is income redirects. Whenever you get a raise or a bonus, your lifestyle absorbs it within 90 days. You don't decide to spend more, it just diffuses into nicer habits. The rule is to automatically invest 50% of any new income increase before your lifestyle even realizes the budget has expanded. Languishing below the Phase 1 threshold isn't a harmless delay. Every month you stall on increasing your contributions, you are actively sacrificing the most powerful, longest runway compounding dollars your portfolio will ever have access to. The final lever is the life event reset. When a predictable, significant expense ends, like paying off a car loan, you suddenly have several $100s of unallocated cash flow. An intentional investor executes a contribution increase on the exact day that final payment clears, routing the old payment directly into the market. This is an architectural system, not a test of willpower. A decision made in advance and automated today always executes flawlessly. A decision left up to your future self, while actively holding newly freed cash flow, almost never goes toward investments. In Phase 1, doing nothing in a boring index fund looks like passive failure. You see social media screenshots of others in Phase 2 and conclude your strategy is defective. It isn't. Staying disciplined through the early grind is statistically the optimal decision you can make. The people who actually build wealth aren't searching for secret strategies. They aren't timing the market or picking the perfect stock. They simply figure out which phase they are in, they engineer their cash flow to feed the engine, and they force themselves across the threshold until the math finally takes over.